Frequency Podcast Network. Stories that matter, podcasts that resonate.
So if you judge a year by the headlines, this year has been a little bit busier and more tenuous than others. We've had a trade war, a war in the Middle East, massive swings for oil prices and gas, consumers beset with inflationary risks, central banks maybe or maybe not raising interest rates. Earnings, for the most part, for companies have been really strong. The AI trade in full effect. Massive gains for some of those AI tech names. Others haven't done quite so well. But at the end of the day, I was looking at the state of the markets, and through the month of July, hey, it's not a bad performance for North American benchmarks. The TSX and the Dow, both up by about 11% each. The Nasdaq seen some pretty big swings. Stock market benchmarks are at record highs. If you did nothing since the start of 2026 with your investments, you're in the money, just sitting on your hands. Of course, human nature being what it is, that's pretty tough to do. When you see these massive gains or losses and the fear of missing out in full effect. So how do you kind of smooth things out, and what should the strategy be for the last part of 2026? Welcome to In This Economy. My name is Mike Eppel. Joining me on the line today is Jordan Damiani, Meridian Investment Advisor and Certified Financial Planner. Jordan, how you doing today?
I'm doing well. Thanks for having me, Mike.
Yeah, so this has been a year, over 7 months. But at the end of the day, do we get too transfixed by the headlines, Jordan? That and I'm part of the problem, talking about it all the time on business reports. But yeah, it's been one of extreme volatility. But at the end, it's another positive showing here for North American investors.
Yeah, and I would agree with you. I think there's been just so many headlines that are anxiety inducing. And I think really goes back to some of the core themes for investing, which is just managing behavioral psychology. So, that's one of the big tasks that we have as a financial planner. How do you keep the members that you work with calm? How do you keep them invested? Because there's a lot of reasons, especially, the conflict in Iran, a lot of the other things that you'd kind of reference as rationale to jump in and out of markets and exhibit some of those bad behaviors that we always, talk against, like market timing. So I think, on my end, it's really just reinforcing some of the fundamentals around financial planning.
Okay. I've got to admit something that I think, and this is maybe I'm even late to this game, but I am inundated, and maybe it's the case of the algorithms catching up to me, by financial influencers, those finfluencers or whatever they're called, telling me what stocks to buy. And of course, they always say, this is not financial advice, which I think is just ridiculous. But anyway, you see, though, at the same time, the gains for AI names. Micron is up 800% this year, Jordan. How do you avoid not getting caught up in that when we're basically bludgeoned over the head with this on the daily by the minute?
And I think you really have to take a step back and really look at, asset allocations and diversification. So you're right. There's been some eye-watering gains. There's also been some eye-watering losses. SpaceX is a great example of that, where
that's very fair.
You have the IPO absolutely explode, and then all of a sudden it's the market cap is more than Microsoft or Amazon, and then you see that quick 50% drop. So I think you have these dynamic where there is a gambling element to financial markets. There doesn't have to be, and I think when you think about building wealth long term, you really want to stay away from the high risk, high volatility portion, and you really focus on the consistent outcomes. And I always joke with people, when we talk about, market volatility and all the headlines, that we've always lived in a crazy world. I've been doing this for 14 years, and there's never been, a stretch of time where there's just been calm and markets go up and there's been nothing to talk about. So it's definitely the function of the markets to always have something to focus on.
To some extent, this is the meme stock craze on steroids this year. We go back to, when was it, 2022, when GameStop was, a lot of what had dominated the day. And again, coming back to the Reddit crowd and that, well, now it's more it's almost more mainstream because there are so many companies, it's not just one particular or a couple that are involved in these, 100, 10 bagger or 100 bagger gains that you see almost on the daily. So, is this just maybe a function though of the market technology and all of this, when it's what have we just seen in the past week? Microsoft's up 25% in 3 days. You've never seen that before. And we're talking a company that's been around for years, one of the most valued companies in the world, and it goes up that much. Or it could come down that much. Who knows?
Yeah, if I had to kind of share my thoughts on that, I would just say we've adopted this, 24/7 connectivity culture, but also there's this overlay of gambling culture where you think about you can, it's never been easier. You have, your phone with you everywhere. You can bet on it. You have the concept of it's not gambling, it's a prediction market. And the same thing with, Reddit sharing kind of posts about, high risk option trades that, either make extreme gains or extreme losses. And I think, you can even maybe drill a little bit deeper in terms of a little bit of the economic malaise that you might have, or you might feel if you're a millennial or Gen Z, that it's really tough to get ahead. So if you might, perceive that, hey, I really need almost like a lotto win type experience to get me ahead. And if I get that, then I'll be okay. I think it really encourages people to take, the volatility route versus the slow and steady, which is, often boring, but it works. It's just not that exciting. It's that, kind of time in the market, not timing the market adage.
Yeah, well, you've also got an American president who's basically saying the quiet part out loud when we're talking about, how much social media, specifically Truth Social, and the president's posts can move things on the daily by the minute. And, the trading pattern that's actually created. Again, that's coming back to the idea, well, if everybody's getting rich, why the heck am I not getting rich? So, I mean, it fuels that FOMO culture. And like you say, the gambling aspect of it, where nobody seems to be worried about the Kalshis and the poly markets and the effect that's actually having for both good and for bad.
Yeah, no, I agree with that. I mean, obviously the story kind of came out that with Truth Social, they were selling, early access to the API for 100,000, which, is pretty dubious. And I think, it kind of goes back to the gambling mentality when you go, well, who wins? It's the casino that wins. So it's the market maker or a person that issues the coin, the crypto coin or the crypto token that wins. And I think our, idea of what true investing is kind of becoming obscured, in my opinion. And, instead of really focusing on, consistent corporate earnings or good dividend paying stocks or, themes that have made, Warren Buffett one of the richest people, in America or globally. We're really focused on, hey, how can I triple my money in one day?
Well,
and it just doesn't work.
Nobody talks about price to earnings multiples.
Right.
Like that just like the literal fundamentals of why you would invest in a company for a long term or market, it doesn't, that has been pushed by the wayside. And you talk about Warren Buffett, how many times have we gone through the declaration of the new Warren Buffett? And, just last week we had the collapse of a U.S. hedge fund by this Leopold Aschenbrenner person who, of course, was, a star until he wasn't, when his leveraged accounts basically were collapsed. And prior to that, it was Cathie Wood. And prior to that, I mean, you could, lump Bernie Madoff into the mix. We get caught up with these influencers and the next thing. They always say, oh, this time it'll be different. It's never different.
That's right. And I think, as an investor, you really have to focus on what exactly am I being sold? What exactly am I investing in? And I mean, when we're on the themes of the Cathie Woods, as an example, what's the narrative? And I actually, would bring up Elon Musk as a very interesting one, because he recently made the comment that, if everything effectively goes well, that SpaceX should be worth more than planet Earth. So, I mean, that's a pretty, I wouldn't even call it eccentric comment. It's just, it's hard to believe. And you go, okay, what am I actually investing in? Is it a satellite internet company that really needs technology that effectively they haven't even successfully launched yet to make it real? And then again, you see that 50% plus decline in the stock, and it kind of makes sense, that you're buying hype, at least in the short term, versus real earnings.
No one, I mean, except for the most dogged among us, actually read the prospectus for that IPO.
Right.
Like that's that is also part of the issue here. Okay, so I'm on the radio talking about all this stuff every day, and I'm being inundated by social media. So what are your clients calling you about? Are they literally saying, "Hey, how come I'm not in X or any?" And I'm sorry, I called it X, not to be confused with Twitter, X stock or what have you. Why am I not? Do you have to kind of deal with again your clients saying, look, worried that they are missing out on some big money making opportunity?
So I think the modern day role of a financial planner has really changed, in my opinion, just because I actually look at my roles. I have to combat. You've referenced the finfluencers earlier, who they're not licensed. There's no accountability. I'll tell everybody I have skin in the game. I'm accountable for the trades we place. Knowing your risk tolerance, time horizon, all the important know your client kind of parameters. So, that's certainly a big focus for me. So how I combat the behavioral psychology is information and financial literacy. So for me, I personally spend a lot of time and effort each week. I'll send out a newsletter to the members that I work with, just covering all these themes in real time. I write it Friday morning, I send it out, and it's always going to have a mixed bag of topics. So I actually, spoke to the SpaceX IPO just as an example, but really as a caveat of the concept of FOMO. And, I think we don't have a crystal ball. We don't need a crystal ball, but we know, that the fundamentals work in investing. And if I can really keep people focused on that, I don't really have as many questions about, hey, missing out. What I think human nature to have questions about are really just the unknowns and uncertain themes. So for instance, do you have any idea what interest rates are going to do in Canada? Are they going to go up? Are they going to go down? Another big one was just the headlines that really make noise. So for instance, that was Canada hit the technical definition of recession, where Q4 2025, Q1 2026, we had negative GDP growth. So those ones are really, I think, where it triggers in people's mind to say, hey, should I be worried about this? Should I ask for more information? But I do find when they get the information they're looking for, it does help with kind of relative calm.
Yeah, I mean, it's true when you kind of actually sit back, do a little bit of research, and literally calm down a little bit. Things do make sense. You can kind of see it. Of course, 2020, hindsight being what it is, that you go, okay, it played out the way you kind of expected it to. Companies that were out of favor early in the year, now they're kind of coming back up to the mean, and same thing with the economy. I thought it was kind of interesting in the second quarter. Canada actually outperformed the U.S., which I find sweetly ironic. But when we're talking about the rest of this year, what are you seeing? What are you telling your clients about what to expect? It doesn't look like the Bank of Canada is probably going to do anything right now for a while. So is it just kind of a sit back, relax, see how the trade file goes, or something of that nature?
Yeah, and there's one really interesting thing I've noticed over decade plus is, and you kind of referenced it earlier, when investment returns are really good, people are very I think amenable to tuning out the noise. And I think you see that a lot in terms of whether the economic data is good or bad. People really aren't hyper focused as long as they look at their portfolio and they see really good investment returns. I think for me, the kind of indicators that I would look at, and you kind of reference strong GDP growth in the second quarter, which is great to see that Canada's bounced back. But we've really got this theme both in Canada and the US of, the risk of stagflation. Do we see inflation continue to go up, which could force the Bank of Canada's hand or the Fed in the States to raise rates against slowing growth? And I mean, that's definitely, not a good cocktail for someone's household budget as well as the financial markets. So those are just things that you look at. And I think that's why there's such an impetus to have lower energy prices and for the Bank of Canada to just look at the energy spike as a temporary, because we are still meaningfully above the 2% inflation target by the Bank of Canada.
Well, you talk about when people actually pay attention to these things. Stocks and markets hitting record highs. It's almost like, oh, that's good. That's fine. When people freak out is when they start losing money or seeing them, when you hear about a correction on Wall Street or whatever. It's market psychology is one of those weird things. People never buy stocks when they're on sale. They always seem to want to buy them when they're at their highest price. You have to kind of talk people through that too, don't you?
You do. And I mean, there is also, that when you talk about behavioral psychology, there's the anchoring. You say, okay, with markets hitting all-time highs, you say, okay, well, what's the highest my portfolio has ever been? And even if you're up, 10, 15% hypothetically this year, if you're down from the high, your brain triggers, oh, this isn't good. I'm not as high as I could have been in terms of my investment return. So I think there's always, and unfortunately for a lot of people, something to worry about. You hear that dynamic and you kind of referenced it. If markets are low, well, that adage, buy low, sell high, people kind of feel like they have an unlimited timeline to wait. We saw that in 2022 into 2023 when markets took a long time to kind of fully rebound. People were content staying on the sidelines and they had this perception that they had a lot of time. I think when you see markets hit highs, then it's okay, well, something negative is just around the corner. And I think the challenge is it's always a byproduct of corporate earnings. So as long as corporate earnings continue to increase, then the market isn't quote unquote high. But then again, that's impossible to know. And I think the way to combat that is, again, through, proper diversification, having a financial plan, good quality, management in the portfolio, just to navigate through these periods of uncertainty.
I saw a really good meme this morning, actually, where on one half of the screen you see the person yelling, "Take some profits, the markets are at a record high," and the other side of the screen is, "That's okay, I'll just take a screenshot of the performance." Listen, on all seriousness, though, does this come back to the idea of, okay, to avoid, buying when it's way up or not buying when it's down or selling? Does that come back to the whole theory? If you've got a long-term time frame, dollar cost averaging on certain, investments, whether it's ETFs or funds or individual stocks, dollar cost averaging really kind of smooths out a lot of the turbulence?
Absolutely. And I think, you talk about that as just a fundamental to how you enter the market. So usually if somebody has a substantial new amount to invest, we'll kind of talk about their comfort and we'll say, okay, are you comfortable, given that we're not talking about putting concentrated bets into really risky holdings? Are you okay going in a lump sum for this diversified basket or, averaging into the market? And I think, if you look at the period, peak volatility with the Iran conflict, that was a period where if you have especially newer investors, you'd say, okay, what are you comfortable with? And the most important thing is you being comfortable. And again, you kind of revert back to the financial literacy piece in terms of saying, hey, here's the range of outcomes. And then you kind of come up with a plan. And I think the most important thing is if you are dollar cost averaging, you have to stick to it. Because, if you look at it and you say, okay, well, I'm putting in, a third over a 3-month period, and then you have a substantial market decline, it might be tricky for some people to pull the trigger on that next increment, but it's to your advantage to do that. You just kind of have to have that long-term focus in mind.
I gotta leave it there, Jordan. Thank you very much for doing this today. Nice talking to you. I like to, we talk a lot about the headlines. I mean, that's our kind of our bread and butter. So I don't want to see things slow down too much, but at the same time, we'll see how the rest of the year goes. It was nice talking to you.
Yeah, always a pleasure talking to you as well, Mike. And you have a wonderful day.
And that was Jordan Damiani, a investment advisor with Meridian and certified financial planner. Hey, thanks for listening today. My name is Mike Eppel. You've been listening to the In This Economy podcast. If you want to drop me a line, I'm at mike.eppel@rci.rogers.ca. Or on social, I go by @Eppman. That's EPPMAN. We'll talk again soon.